Hey guys, this is going to be a look at SPX and ES starting here on the monthly chart going back to 1980. This is just a very simple and clean diagram showing the series of highs to highs extensions we've been going up in since this top over here in 1981. This is a log scale monthly chart using log scale fib levels. And then if we throw some labels on it, this is what I want to talk about briefly. If I get a version that I can annotate on here. And so this is simply showing, the 87 crash was a 50% retracement into a highs to highs retracement. It was pretty clean. The 2009 crash was a 50% retracement into a highs to highs extension. And during this 2009 bull market, we've traded highs to highs extensions twice, 2000 highs to highs. And so, I want to call attention to these fifth waves going up in extensions. For example, in 87, the run up, that fifth wave tacked on almost an additional 90%. That was almost 100% retraced in the 87 crash. This was the anchor for the 2000 extensions, the run up into 2000, tacked on 156%, and that wave was 100% retraced in the 2009 crash. So, fifth waves going up in extensions, it's almost like their purpose is to push the market so far that the ensuing retracement, when it retraces the fifth wave completely, it just comes back to the starting point of the blow off. That's what happened in 87 and in 2009. And so the question now is, well, one of many questions, but this 2009 bull market, is this entire structure a fifth wave going up in highs to highs extensions using the same anchor, 2000 highs to highs? In which case, from the 2000 anchor, we've tacked on an additional 210%. So if this is, a fifth wave here, you can see that they are getting progressively larger and more aggressive. Um, and so now, well, I guess the first thing to pay attention to is if we break the extension we are potentially trading right now, the next significant support level I think is again the 2000 highs to highs extension, which has a 50% retracement at 27.35. That's, I think, a level that every ES trader should have filed away. Um, the other question is, we'll talk about this more. Is this all of five right here, if this is a fifth wave, or is this one of five? And we're trading an extension now, and we'll do that. And we're gonna prolong this bull market longer than anyone thinks possible. That's the question. And let's just assume for a moment that this is a significant top, and we're gonna do retracements. The question is, um, fifth waves get retraced completely. That's sort of their nature. And so, uh, if this whole thing is an extended fifth wave, are we going to come back to the anchor, which would be, the 2000 high? Or are we going to, it's almost like the movie Inception, where you have this series of nested dreams, and when you wake up you start come crashing out of all the dreams, right? So this is a fifth wave. We could retrace to the anchor, which is the 2000 high. We could retrace this entire thing, which is a fifth wave. And the most bearish possible interpretation that still kind of makes sense is that this entire structure on this chart is a fifth wave going up in extensions. Starting here, it's a highs to highs extension 1, highs to highs extension 2, and then multiple highs to highs extensions. And if this whole thing is a fifth wave, then we could retrace somewhere down into the scenario where we're having a second Great Depression, whether this is World War III or the US government defaults on its debt, or rampant hyperinflation? Who knows? But it just seems like, this sort of going up in extensions started when, in the 1980s, sort of with the hyper financialization of the US economy and the deregulation of banking. And so, how much of this is real? I don't know. Uh, None of this helps. It's not tactical trading advice, it's just an interesting thought experiment. We do know that fifth waves, extended fifth waves, get retraced. The question is, at what degree of trend is this an extended fifth wave? Is it this? Is it this to the anchor? Is it this whole thing? Or is it that whole thing? There's just multiple scenarios, and it's an interesting thought experiment. But people who say that we're going back to the 1980s, that's sort of the justification for it. But anyway, is that everything I want to talk about on this chart? It is. The one thing I want to call attention to is you'll notice here when we front ran this, again, these are log scale fib levels on a log scale chart. We front ran the 50% retracement, and then we came back 1, 2, 3, 4 months later and hit it. And again, we front ran it right up here. This is where I'm looking. And we came back 1, 2, 3, 4 months later and hit it. I'm wondering if maybe the linear 50% level was here, and then it came back and hit the log scale fib level. This is a special case. But again, we approached the 50% retracement, but we didn't hit it. And so I think that's everything I want to talk about in this chart. If we go to the Thinkorswim charts right now. So again, starting on the weekly log chart, we've talked about a potential anchor for if this structure wants to subdivide and extend this what might be a fifth wave. And we're using this 2020 highs to highs. The solid line is the linear scale fib level, and these dotted lines are the log scale fib levels. And so you can see today we had, within a couple points, a very clean touch and very strong reaction off of this highs to highs extension. And so, if we want to talk about front running the log scale fib level and then coming back and hitting it, we could have sort of a sideways consolidation here for a couple months before we come back down to 40/40 is the 50% fib level. So I guess, what I want to sort of talk about is, we were using this, this is the 2000 highs to highs extension down here. This is linear scale, and we were looking at this 618 target right here because historically the 618 target has been the top. And we hit it and we had that reaction in the fall, and then we pushed above it. They got one more highs to highs extension in this series before they finally broke it. And then after they broke it, there was yet another marginal high right here. What am I trying to say? I'm just calling attention to the fact that the 618 target this time was not the top. They pushed above it, and they used basically the end of the year, I think, to start lightening up and positioning short. And the other thing I want to talk about is how the trend broke on the weekly log chart before anything looked wrong on the linear chart. And so, we were playing the games right here where we were whipsawing the trend line intra-week. And then we broke it, and we got one more push off of this stealth trend line, which is parallel to the original channel. just drawn off of this pivot right here. And they whipsawed that again, more gamesmanship. And then this candle right here is where technically we got a weekly close below the even the stealth channel right here. And so, technically the trend was over back in when was this? November. Yeah, November, early December is when the series broke, and then they pushed it up into the end of the year. And so on the linear chart, this is the linear daily chart. I follow a lot of technical analysts, and they use channels like this and trend lines, and you can see that technically nothing is broken on the linear chart. If you're not looking at the weekly log chart, you're missing the fact that the trend broke right here. Right? This was lights out. And that's how you knew to start shorting aggressively when these short moves started presenting themselves. Yes, they dip in, but that's just what they do now. So I just want to again highlight the importance of the weekly log chart and how they whipsawed the. I'm going to take this line off actually. They whipsawed this solid line as the top of the weekly channel and closed above it. Again, more gamesmanship. And so the question now is, and this really is the question, is this simply a three-wave move down into a highs to highs extension that will extend this bull market far longer than anyone right now currently thinks possible? um, or is this going to develop a structure that looks more like five waves down? Um, we do on the daily chart. We do have a bullish RSI divergence. It's just undeniable, right? Lower low, higher low on RSI. Um, Coming in this morning, I just knew that we were going to get a reaction off of this level right here. And it was sort of such an obvious setup because it's almost like Putin waited to invade Ukraine until ES was approaching its highs to highs extension on the weekly chart. He wanted those events to align. And so you get the proverbial buy blood in the streets, you touch this huge technical level, and we were way outside the weekly Bollinger Band, the 2 standard deviation weekly Bollinger Band. So there were three great reasons to buy right here. The question now, actually, we're on the daily chart. The weekly Bollinger Band was way up here, and we've since whipped back inside. So the market was looking at all of that today. The question is this going to stick, or are we going to work our way down to at least this level, the fib level, 50%, which is at 40.40, which would allow us to capture this 236 target? And then I think, do I have TradingView up? The one more thing I wanted to look at. Yeah, so if we, is this on log scale? Yeah. So this is ES log scale, and it's interesting that this measured move down that we're in, it's this again log scale fib levels. Its 618 target lines up with the 618 support level of the 2020 highs to highs extension. So when you have a target 618 target line up with 618 support, that's a level that you have to pay attention to. So if we work our way down to 3830, this 3880 more or less is for all the marbles. So if we go back to here, 3880 is, well, on this chart I have it, yeah, it's right here. So this dotted 618 line, And I'm out of time. That's it. Thanks, guys.